day, ladies and gentlemen. Good afternoon and a warm welcome to the 8th SPE Members in Transition Technical Talk series. So the topic for today is a walkthrough of Malaysian PSCs, which will be presented by Amy Yusnita Yusuf. I'm delighted to see the number of people who have dialed in and more are doing so. Thank you for taking some time off, especially during this lunch hour, to show your support for this event. I hope you will gain benefit and insights from the session as we have planned for. Allow me to introduce myself. My name is Aisha. I'm currently working as an analyst at BHP. I'm a member of SPE KL Young Professionals, and I'll be your host for today. All right, I'll be giving a quick overview of what SPEKL MIT is, as this might be the first time for some of you joining this session. With the spirit of continuous learning, SPEKL is organizing a total of 10 talks presented by experienced professionals in the industry. So there are going to be 2 other talks after this session held weekly every Wednesday at 12 noon on Microsoft Teams. So if you are a registered member of SPE, you'll get an email invitation to the event. Don't worry if you're not, because this time SPKL has opened up the series to non-members as well. So be sure to follow us on our social media accounts via the QR code here or the link in the chat box. LinkedIn is where you can get updates on the upcoming talks, and on YouTube, you can catch up on the previous installments of the Technical Talk series. So do not forget to hit the subscribe button. And your feedback is very crucial to us. I would like to request everyone to click on the feedback form link in the chat box and provide your response after the session ended. Not only you can comment on today's talk, you may also suggest topics that you feel interesting for upcoming series. All right. A few housekeeping rules before we start. So the lecture is expected to be 40 minutes, followed by Q&A session 20 minutes. After that, we'll be having a Kahoot quiz. So this is the time to get rewarded for your understanding and focus, as this is your chance to win a 50 ringgit e-wallet voucher sponsored by SPEKL. So later on, winners, do not forget to email us to claim your prize. Throughout the session, kindly mute your microphone if you're not speaking. This session is also being recorded. If you have any questions, please write your questions in the chat box or use the raise hand feature on the panel. So, yep, like again, I would like to remind you that keep your focus on the presentation, because all the questions are like what had been presented by the speakers later on. And don't forget to email us to claim your prize later. Right, now a quick segment on SPE membership, and I'll have my colleague Harvin to talk to you about this.
Hi everyone, welcome to the wonderful talk by Miss Amy after this. So let's all tune in. And before that, there's a short introduction on SPE membership. All right, next slide, please. All right, so this is entirely just to entice you to join SPE. Okay, so in for you to join SPE, you actually get a lot of other not only benefits like all these talks and stuff, but you also get professional benefits. You can be an ambassador lecturer. You can volunteer in SPE. You can participate in accreditation. You get free access to SPE papers, which is like 6 annually. You can network professionally. It's also a form of independent insurance. Free education, like something like this. Visibility and also mentoring. Next slide, please. All right. So for students, okay, right now for students, it is free membership. Okay, you can receive mentoring. You can apply for scholarships, fellowships, and so on. You can even take part in Petro Bowl or a student paper contest. And if you do have any trouble with your career and whatsoever, you can actually request for career guidance and also join us on our field trips. All right, next slide, please. Okay, so during this particular period, the pandemic situation, there are some extra benefits during last year and this year. So there are three benefits. One is the fee for all Malaysians have been reduced by 50%. Number two, free renewal memberships for those who have actually lost their jobs due to the pandemic. And the third one is insurance program for SPE members. Members who are actually transitioning from student to professional membership upon graduation, you can actually get your first year of SPE professional membership free. So that grab the opportunity, as it's really, really good, yeah, for this year. For questions, you may contact customer service at the particular email stated there. And not only that, you can actually get JPT online, which is also an extra benefit during this period of time. Students may elect to have their dues paid by a contribution from Chevron by checking the appropriate box on the student membership application. So currently, the professional membership annual fees is actually about USD 50 USD, and right now, if you are going to change from a student to a professional membership, it is actually free for the first year. Next slide, please. Okay, so there is a promotion going around now on SPE KL. So they have a promotion, and each month there will be two winners. There will be a lucky draw, one lucky draw for physical gift. One more is a chance to actually present at one of the SPE KL activities or even events. I will grab it if I were you, right? Okay, next slide, please. Okay, so just to summarize a little bit, so students, you get a lot of benefits. Professional members, you get a lot of benefits. So students, you can receive mentoring, scholarships, fellowships, petrol bowls, student paper, career guidance, field trips. Professional membership, you can provide or even receive mentoring as well. Become a ambassador lecturer, volunteer in SPE committees, technical talks, trainings, accreditation, and so on and so forth. Yeah, so there are a lot of benefits. So don't wait. Do get in touch with us and find out how to actually become a member. Yeah, extra benefits, there are three, like I've mentioned: free membership for those who lost their jobs, insurance program for SPE members, and one petrol discount as well. Yeah, okay, so register today and start winning. Student membership is free. Professional membership is USD 60 annually together with their servicing fee. Register today and send a confirmation email to the email address shown there to my colleague before 31st of August to actually register. All right, next slide, please. Thank you very much. And if you have any question and answers, we'll be glad to answer them. Thank you.
All right. Thank you, Harvin, for the summary on what benefit SPE membership holds. I really think that this is the best time for everyone to leverage on the fee reduction, either on the new registration or membership renewals. So without further delay, let's jump into the objective of the topic today. So throughout the oil and gas industry, there are many different types of contracts in place that govern the allocation and distribution of petroleum resources. So one type of such contract is a production sharing contract, and it is widely used in Malaysia. Since the first PSC awarded in 1976, Petronas has continuously revised the original version to make it relevant and to address the ever-changing landscape over the years. So over the last 2 or 3 years, newer PSCs like the small field asset and enhanced profitability terms PSCs had been introduced to further reflect the maturing nature of Malaysia oil and gas landscape and to encourage more exploration activities. So this session hopes to briefly cover the fiscal evolution in Malaysia with emphasis on the RC fiscal construct. So a refresher on concepts like cash flow, cost recovery, supplementary payment, and tax will be discussed briefly as well. I am pleased to introduce you to our speaker today. Amy is a staff economist in Petroleum Economics Department, Petronas. She's a chemical engineer by training. Amy has 15 years of working experience with the last 12 years in oil and gas. So in her current role, she provides assurance in project valuations and framing across the upstream value chain. She is responsible for coaching and reviewing the works of other economists in the department, as well as delivering petroleum economics training for internal Petronas learning programs, as well as industry speaker or guest lecture in university programs. Specializing in risk-based economics valuations of projects across all stages of development from exploration to production, she is experienced in both conventional and unconventional resource valuations. And also in modeling Malaysian PSCs as well as other international fiscal regimes. With this, I'd like to welcome Amy to share her insights with us today. Amy, over to you.
Hi. Yes, thank you. Good afternoon, everyone. Let me just share my screen for a little while. Give me 1 second. This should work. We tried this yesterday. Okay. Okay. So just to confirm that you can see my screen?
Yes.
Okay, excellent. So again, a warm welcome and a good afternoon to everyone. We're here to talk about petroleum economics over your lunch period. Hopefully this will cover maybe 45 minutes. And then, we'll take some Q&A. Also, I'll plan to stop briefly between slides to allow people to ask questions. So do type in your questions in the chat box or raise your hand, and I'll ask Isha for her help to maybe moderate and ask your questions for you. Okay, so hang on 1 second. Okay. Okay, so the brief topic today is a walkthrough of Malaysian PSCs. And I'll cover a little bit about how fiscal evolution has transpired here in Malaysia, as well as salient terms on the Malaysian PSCs that you see today. Now, the thing is, it's a mixed background. The attendees are a mixed background, so not everyone has background on economics or petroleum economics. So I'll cover a little bit briefly about what cash flow is and things like that as well. Okay, so why do we bother with economic evaluation, right? Now, if resources were not constrained, if we had unlimited amount of money, would you still do economics? The thing is, every corporation has shareholders, right? So for every dollar spent, you need to be accountable for the return that each dollar brings, right? So economics is done to essentially allow the corporation to determine where to focus effort on, right? So in a capital constrained environment where we are today, it is even more imperative that we distribute our expenditure where it will bring us most return, right? So then, therefore, economic evaluation determines the project value. And from this project value, we can, then figure out how profitable a project is and things like that. So economics is required to facilitate decision making, where to focus efforts, what is the most optimal development plan, for example, or development option. And essentially, if you're thinking about, farming into a new block or exploring a new country or a new area, you want to ascertain whether you have sufficient, risk versus reward, right? You take on risk for exploration. Do you have sufficient reward insofar as what you take home? So another reason why we do economics, certainly in our organization, is to actually determine the economic health of a project. So it's not just about every dollar that you plan to spend, but every dollar you have spent, has that dollar been working for you, right? So you want to look into tracking perhaps an asset's performance. Is it making money? Is it giving you the return that you promised the organization? For example, you would be running economics to find out how much tariff you're willing to pay to tie through someone's pipeline and stuff like that. Okay, so essentially we do economics from start to the end. So from inception, where we do exploration or farm-ins, all the way to asset decommissioning. Economics is always done even at decommissioning level, because you need to ask yourself, at what point can you start decommissioning your assets and winding down the production, right? Okay, so this is most probably familiar to everyone here, but just in case, uh, this is the typical economic analysis workflow. We start with, a bunch of inputs from everyone. So this is really, economics is really where all the inputs are amalgamated into a single model for us to forecast what the future looks like, right? So typically, economic forecast is more than just 2, 3 years. It goes on 20, 30, sometimes 60 years, depending on where you are. And it starts with technical inputs. So sound technical inputs are always required to do a good economic analysis because, the the coin term in economics is garbage in, garbage out, right? So, we require things like production profile, cost profile from the cost engineers, both capex as well as operating costs. And then this will be married together with corporate assumptions or what your corporate thinks the oil price is going to be for the next 10, 20, 50, 60 years, right? So you've got escalation assumptions and foreign exchange assumptions. So all this gets married together in the economic model. And the economic model will run, it will just, okay, I make it sound as if it's a black box. It's not. It's a series of calculation that will help you go from revenue all the way to net cash flow. Okay, and from the net cash flow, what you can do is you take that on, and then you see what can the cash flow tell you something about the project, right? So then we'll start looking into what the net present value of the project is, what the rate of return for the project is. Are there any other things that you want to know about the project? How long will it take before the project breaks even, for example, right? So these are all the things that you can do once you have the net cash flow. And then from then on, we also tend to do sensitivity analysis. So these are like what ifs. What if production was higher? What if prices were lower, right? So all this is then done to essentially have to allow us to form a picture about what the value of the project is. Okay. So that's essentially the typical economic analysis workflow. We tend to go through this, this is quite a generic approach and it's not, everyone does this essentially. Okay, so I talk about net cash flow. What is net cash flow? Okay, so net cash flow is essentially just cash in minus cash out, right? With the emphasis on the word cash. Okay, cash is important here because there are other types of cash flow, not just net cash flow. You have financial cash flows, for example. That's what the accounting and finance group will typically work with. It contains non-cash items and things like that. Okay. So net cash flow is done to determine the economic merit of making an investment. Simply put, this is just, your budget every month. You have your net cash in, which is typically your salary. And then what is cash out? That's like a lot of cash out items, right? So it'll be like, EPF, tax, zakat, and then like, living expenses, housing loan, car loan. So very quickly, you can find out whether your net position is positive, i.e. you've got money in the bank left after paying all those bills, or negative, right? And we all know what negative numbers in banks mean, right? That's not necessarily a good thing. So similarly with net cash flow, okay, if your cash in minus cash out is negative, then you have to ask yourself whether this is the right thing to do, right? Typically, we aim for a positive net cash flow in projects that we do. There are sometimes that we still continue to carry out the project even if it's negative for reasons. For example, if you have to replace a flare tape or a safety reasons typically, right? But by and large, most investments are done only when your net cash flow is positive. Okay. So what are the things that what are cash in, right? In oil and gas economics, what is cash in? Cash in will be things like your revenue, so sales from oil and gas. It could be things like you have an infrastructure and someone's tariffing through it, someone's sending their production through it, so that's tariff income. Okay, it could be other types of income like premiums and things like that, but that's not so common. And then with regards to cash outflow, what is that? So that is first and foremost the investment, right? The capital investment, your platforms, your facilities, your wells. That's all the cash coming out the door, going out the door. Then you have your operating expenses, right? So whereas capital investment are one-off in nature, typically before production starts. Okay, operating expenses is something that you have to pay throughout the life of field, and that's for operating your asset, right? So that's your manpower costs, your chemicals, running your wells, and things like that. Okay, you have other things like fiscal costs, right? Fiscal costs are royalties, taxes that you have to pay, export duties, any bonuses you have to pay to the government or host authorities. And there's also things like premium payments. So the opposite of receiving premium is someone has to pay it, right? So that's a form of cash outflow too. Now, in the simplest terms, okay, cash flow is essentially a projection of cash, and it's the cash balance after deducting money spent from what you have earned. Okay, so is there any questions up to this point, Isha? No, right? Okay. Okay, so how do we simplify this in our head? It's not enough to just say cash flow equals cash in minus cash out. Okay, so how do you think about this? How do economists think about this? So we typically draw out a revenue flow diagram. Okay, and this is something relatively straightforward. So it's essentially, project revenue, which is production times price, right? To give you revenue, then you take away OPEX, which is your operating cost, to get income before tax. Okay, and then you take a side step to the right and calculate how much tax you have to pay. And then what is important is the amount of tax you have to pay, the cash tax itself, right? So you deduct from your IBT, your income before tax, the tax that you calculated, and then you deduct capex to get your net cash flow after tax. Okay, now I make it sound as if you have to take side steps left and right, but basically it is important to note that when we calculate taxes, we use a slightly different mechanism to end up with how much tax you have to pay, right? So if you think through to your own income taxes, right? You know how in Malaysia we have deductions, right? So for individuals, your deduction is 9,000 ringgit. Now that deduction is to allow for living expenses, but everyone living in this era knows that 9,000 is not sufficient for your living expenses. So that's what that the deductions are. The deductions are not necessarily what you actually spend. With regards to capital expenditure, it's actually scheduled out, right? How much you can deduct for your platforms, facilities, wells are not taken all in one go in the beginning, but rather it's spaced out over time. Okay, and that is what we call capital allowance, or sometimes we call it depreciation, if you've heard of it. So you do all this calculation to the side. What you need from the tax calculation is just how much tax you have to pay. Okay, so that's essentially the sequence of cash flow. And then in the end, you take away the capex you've paid in terms of investment for that particular year or time period to end up with the net cash flow. Okay. So what is most important is, even doing this, if you know nothing else about a country's fiscal regime or whatever it is, project cash flow is important because it helps you determine whether a project can cover its own costs, right? So again, like the budget situation, what's the point of doing something if you don't even get money back from it, right? So at first level, any good economist will start exactly there. It's called project economics. It's just a simple revenue minus cost. Sometimes you minus tax, okay? And then you ask yourself, does this generate profit? Okay, if it doesn't generate profit, then you have to think seriously, can you do something about it such that you can maybe optimize, reduce costs, or increase production, to end up with a positive net cash flow, okay? Because this goes on to the next part, right? Once you have something to share, once you have profit, that's when you figure out, how do I split this profit between myself, the host authority, or the opposite? The host authority will ask, how do I split this profit between myself and the contractor? Okay, so any leftover revenue after paying for capex, opex, abex is called divisible income. Okay, so this divisible income is important because this is how this is where you start when you talk about wanting to split your income between host authorities and the contractors. Okay, so and this in the oil and gas industry is governed by petroleum agreements, essentially. Okay, so fiscal terms, like I said, will only work when there's something to share. If there's nothing to share, then that's it's not that it's pointless, but you'll be hemorrhaging money, right? So not all parties are enjoying the benefit of the resources, essentially. Then, okay, any questions up to now? No. Okay.
Yeah, we do have one.
Okay.
From Kausalya asking, is capital allowance same as capex?
No, actually, capital allowance is not the same as capex. Capital allowance starts from capex. Okay, so if we go, so I'm going to go backwards in time. Okay, so capital allowance starts from capex. So, for example, if I spend 2 billion ringgit, okay, 2 billion ringgit trying to build a platform. Okay, so what happens is the money out the door is 2 billion ringgit. But capital allowance is what I get to deduct in my tax computation. So I don't get to deduct the 2 billion. I don't get to deduct 2 billion ringgit in one go. What I have to do, according to the rules set out by the Inland Revenue Board, is I have to spread the 2 billion over time. Okay, and that's because production from this platform is over time. So typically there's a somewhat matching principle where you try and match your costs to your revenue, right? So in this particular case, I've spent 2 billion for a platform that has a 15-year life. So I have to spread out the benefit or the cost, right, to that you get benefit from over a longer period as well. So you don't take the deduction up front, you take it over a period of time. So that spreading of capex for your deduction in calculating tax is what we call capital allowance or depreciation. Okay, so I hope that's clear. If not, then just write on further and maybe I'll try and answer better. Okay, so going back to this, petroleum agreements. Okay, so what types of petroleum agreements are there that we have known? Okay, so petroleum agreements typically is split up into two parts or two types. One is the concession type, and the other is contractual type. Okay, so concession systems are typically then covered by concession agreements. These are typical of say places like the US. The US predominantly is concession type or agreements. So you have the resource owner, signing a contract with the person extracting the resource, the resource extractor, okay, and agreeing to pay X amount of fees or X amount of production for allowing them to extract resource from underground, right? So this is where, for concession systems, it's not necessary that the resource owner are government or government bodies or host authorities, right? Resource owners sometimes are people like you and me. In the US, on conventional business, that's what it is, right? The landowners are farmers, mom and pop companies who own lots of land, right? Even universities own land, right? So if oil and gas companies want to explore and go and drill and produce from that particular land area, then they have to sign a concession agreement with the resource owner. And the resource owner will stipulate then how much is the percentage of revenue he or she wants to keep for themselves, right? Okay, so that's the concession system. Now let's jump over to the contractual system. There are two types of contracts. We've got service contracts as well as production sharing contracts. Okay, service contracts, we have pure service and risk service. Now, what is the difference between these two? In my head, if I simplify things, by the name, you can just know what it is. Pure service is just, party A paying party B for providing a service, right? So it'll be a host authority saying, go and produce from this field. I will pay you $2 a barrel. Okay, and I'll pay for all the costs. You don't have to take any risk. You just charge me your fee I'll just pay you $2 for helping me produce this, right? And I'll cover the cost and everything else. So that's a pure service. A risk service contract, however, carries an element of risk in essence, right? So so what happens in a risk service contract? An operator or a contractor expects to be rewarded, more than just for the cost, but also for taking additional risks in developing the resource or carrying out the development plan. Okay. Now we go on to another type, which is what I'm going to focus on today, which is production sharing contracts. This is what, I think predominantly almost like 95% of contracts in Malaysia are production sharing contracts. We have a few more risk service contracts, I think, but that's expiring soon. Okay, so what are production sharing contracts? Okay, how is this different from all the other contracts that I mentioned before? Typically, production sharing contract is signed between a host authority, a governing body, and a contractor. Okay, and like I said, this is talking about how to split the divisible income, right? Something that you can share, essentially the profit, and hopefully, this split should provide equitable return reward for the risk that that the contractor undertakes, right? Okay. One key feature of PSCs, and it's not definite, not all PSCs will have this, is it allows contractor to recover petroleum costs. Okay, the fundamental thinking or thought behind this is the resource owner are the host authorities, right? So you've got someone else to come and essentially develop the field, right? So, but ultimately the resource owners are the host authorities. So therefore, I will pay you back the cost that you have to fork out to develop the field, right? That's what cost recovery means, right? And typically, PSC tries to adopt a partner approach in dealing with investors or contractors, because it's about shared risk and reward and hopefully shared benefits as well. And PSCs try to create a conducive work environment to facilitate essentially business activities, right? So imagine this: if you are a host authority, you have to think about how best to incentivize contractors to want to invest into the field or the country, right? And what terms would make sense? What's the right balance of risk and reward such that it is, rewarding and beneficial enough for the contractors to come in and essentially do business in the country, right? Okay. So, and you might be taken aback by all this, but let's just stick to this one by one, okay? Left to right, top down. Okay. So, so this is the typical revenue flow diagram for Malaysian PSCs. Let's start with the left part, which is the project economics, okay? In project economics, like I said just now, it's just simple revenue minus costs. Okay, revenue minus OPEX and CAPEX to end up with some net cash flow. Okay, so this part here should be relatively straightforward. Let me just point. Okay. Okay, and then we talk about contractors' cash flow. Okay, so contracting parties who sign a PSC with with Petronas essentially, their cash flow will look like this. What is income? What is revenue to the contractor? It's essentially what they get to recover from as cost recovery, okay, and what profit they share, right? So if we think about the pie chart from before, the cost, because the contractors have to pay for it first, they get to recover. So that's an inflow, that's a cash in, right? And what's remaining of the profit of the pie is shared between contractor and government, right? So that's also a cash in, right? So the contractor's profit share and the cost recovery are cash in items, okay? And what is coming out the door? What is going out the door? So it's essentially, the contractor has to pay for operating costs, for CapEx, for tax, which we covered just now. And also in Malaysian PSCs, there are other payments that we have to pay. So things like export duties, supplementary payment, research cess. That's a few. List is not very long. It's not a laundry list, but there's a few more items which are essentially cash out. Okay, and these cash out typically is paid to relevant governing bodies. So not all payments end up with in this case Petronas. It could go to, for example, IRB, where taxes are collected, customs, where import duties are imposed, right? So different parts of bodies, okay? But essentially, they all belong in this category, which are host authorities' cash flow. Okay, so host authority cash flow, relatively simple. Everything that comes into host authority is all that comes in as cash in. There's typically no cash out, at least visible to outside anyway, right? So you have, for example, the cash payment. In Malaysia, royalties are called cash payments because that's how the term is coined in the PSCs. So royalty is a cash inflow for the host authority. Any profit share from the pie is then a share of cash in for the host authority as well. Any payments made to the host authorities like supplementary payments, etc. Okay, and tax. So different bodies, like I said, are collecting all these things, but from an investor's point of view, they all go into the government of Malaysia, right? So all this then is the net cash flow for the host authorities. Okay, so I'm gonna pause. Is there anything so far up to this point? Shouldn't be, but no.
Yeah, there are
There
quite
are?
a number
Okay.
of questions here.
Okay. Do you want to go ahead and ask maybe a couple before I move on?
Yes, I think let me try to identify. Okay, from Ameisha, what sort of petroleum agreements are there for decom related?
Okay. Actually, we'll cover that in 2 slides, so I'll hold that
Alright.
question for a minute. But I'll cover that insofar as what we have in Malaysia to cover decommissioning. Okay. Anything else that you want me to cover right now, or not?
Maybe from Rosma, what if the exploration or appraisal fail? Are these costs recoverable?
That's a great question. With regards to PSCs and whether a cost is cost recoverable or not, typically for exploration costs, if it is just if the company only has that one asset, okay, and it's just got that one block and is trying to carry out exploration activities, that cost is typically not cost recoverable, because for you to recover that cost, you need to have production, right? If it's a dry hole, you can't recover that cost at all. But however, if you explore, find something, right? Say for example, you drill 3 wells, only one is a fine and two is dry hole, right? So then you can produce from this one field that you found. So you can recover all the other exploration costs in the block from that field essentially. Okay. So the challenge is, there's an element of risk, right, that's involved here. So any exploration typically is then mostly taking is the contractor undertaking the risk to explore. Okay. And then if they find something, they get rewarded for it or they get repaid back for taking that risk, right? The challenge is if you don't find anything. That's why it's better to have sometimes a portfolio of assets and not just one, right? Okay.
I
Cool.
think
Okay, let's move along to the next part, which is about the barrel split. Now, if we go back to this, right, you can see how much of this goes everywhere, right? So you can simplify this by essentially looking at this from a point of view of a barrel, okay? You've got project economics, which is just, revenue minus, so the barrel is the revenue itself, 100% revenue. So part of it goes to cost, part of it goes to tax, and some of it are remaining as profit, right? In the PSC economics, the barrel looks very different, okay? So a portion of the revenue goes to royalty, a portion of it goes to cost recovery to recover costs that you spent, okay? And then the remaining profit is shared between contractor or host authority, contractor and host authorities, okay? The thing is, the contractor still has to pay tax on their share of profits, okay? So you can see that here. Let me just turn on this pointer if I can see it. I can't see it, okay. So if you can see here, pay attention to this part of the chart. So whatever profit that's left remaining is split between the state or the host authority and the contractor, and the contractor pays its share of tax from that profit, typically, okay? So what investors receive as gross revenue is something we call entitlement, and it's essentially your cost recovery plus the contractor profit share, which is, inclusive of tax barrels, okay? So one thing that people should take note of is, what does it mean when people talk about net take? You hear about this sometimes. You see it in publications, right? Where there's a chart that compares all the different fiscal regimes in the world, and Malaysia stands at the bottom where the government takes 85% of your profit, something like that, okay? And Australia, it's like 50-50, and Iraq is 99% of all the profit goes to the government, right? So it sounds like really jarring, but then you have to ask yourself, what does this number mean, right? That number is typically the contractor net take, or in my example is the government net take. Okay, and it's essentially the portion that goes to the contractor net of cost. Okay, so let's not worry about how much it costs to get that barrel. If you remove that part, what's left, which is the profit, right, essentially, is then what you see, how much of the percentage of that profit goes to the contractor. So it's essentially profit to the contractor. In this case, is this green slice here over the total revenue minus costs, just the cost recovery, okay? Not the other types of costs, not the royalty, not the tax, not the profit to state, okay? So that's what contractor net take is. Hopefully I'll take you through an example of this calculation a little bit later in the presentation. Okay. Now, someone asked us now about decommissioning contracts, right? So, you know, this is a heavily talked about item or issue discussed in the industry, simply because, you know, Malaysia oil and gas industry, and actually anywhere in the world, decommissioning is something that is, you know, at the back of our mind, right? I think in my previous presentation, like we're about to spend 20 billion ringgit over the next decade in decommissioning, right? So that's a lot of money to just retire assets, right? So in Malaysia, what we've done is we came up with this contract called Late Life PSC. It is to address the fact that, you know, a lot of our assets are late life. I'll talk about it a little bit more. But in essence, you know, a specific contract for decommissioning that can just be handled through any other normal contracting services, right? So just like your O&M, operations and maintenance, all those types of contracts, you can just get a company to come in and do the decommissioning work. What is more interesting and what is more, you know, something that's more relevant to this discussion today is, you know, is there any way that the host authority or governing bodies can make it easier for the contractors to come in and, you know, extract the last remaining barrel from the field and then do the decommissioning, right? Is there a way to limit those liabilities and things like that? So in Malaysia, that is something that we're taking on seriously. We're looking at seriously as well. You know, but before we ended up where we are today, this started ages ago in the 70s when everything in Malaysia was just a concession agreement. Okay. In the 80s, we introduced this thing called 1985 PSC. That's a relatively, you know, popular PSC. It's been slowly phased out now because it's now like more than 30 years, right? Almost 30 years, right? Almost 30 years. More than 30 years, sorry. More than 30 years that it has been around. So typically PSC contracts last for 20, 25, 30 years, depending on the field production. And so they get moved over to a different type of PSC, right? So in the 85 PSC is a production-based PSC. I'll go over an example of what that actually means in a minute. And then, you know, the most famous thing that we're going to talk about today is the 97 PSC, which is the ROVC PSC, okay? ROVC PSC is a new step, you know, a couple of decades ago in trying to move towards a profitability-based versus a production-based, okay? When I say profitability-based, what does it mean? It means that the share between the government and contractor is determined based on how profitable that project is or have been, okay? Over time, this has evolved. We've accommodated the fact that a lot more new fields are considered high pressure, high temperature, right? So we have a specific PSC addressing, you know, HPHT fields. It's typically based still on the ROVC PSC, but with modified terms, right? We have the progressive volume base, the PVB. Very few contracts in Malaysia have this. This is essentially to encourage brownfield investment, right? So the more you invest in the later part of a field life, the more percentage a contractor gets. And like I said, the last 3 years, we've been quite busy over on MPM side. We came up with the Late Life Asset PSC. This is to address, you know, aging fields. Okay, not that it's zero, there's something remaining. The challenge is sometimes, you know, at the end of a field life, fiscal costs could be relatively quite high, right? By that I mean sometimes the cost recovery is relatively low and the contractor's profit share is low, so it doesn't make it attractive for the contractor to continue, right? So the Late Life Asset PSC is supposed to address that. In late in an asset's life, right? Then we also have the small field PSC, so small field asset PSC SFA. So the SFA is to target essentially smaller fields, not small but smaller fields. Okay, so typically the ROVC PSC is sized around 30 million barrels ish, right? So things sub 30 sometimes, you know, people find it difficult to make it work. So we're targeting, you know, the 10s or 20s million barrel fields through the small field PSC. And then what just came out this year is the EPT, Enhanced Profitability Term PSC. Forthwith, from now on, all new exploration contracts, shallow water, will take on this EPT terms. Okay, so I'll go over the last three terms, last three PSCs, which are relatively new to everyone, in brief detail a little bit later. Okay. Okay, so I mentioned the 85 PSC is production based. What does that mean? Okay, so essentially, the profit split between the host authority and the contractor is determined based on how much you produce. Okay, how much the contractor or the asset is producing. So in this particular example, you can see here, right? So for the first 10,000 barrels, they could specify 80-20. For the next 10,000 barrels, you get 70-30. Remaining that you produce above 20,000 barrels, for example, could be 60-40. 60% to the contractor, 40% to the host authorities, right? So I'm not talking about this barrel itself being split as such. Rather, the profit portion is split according to a weighted average of what the production is. Okay. Luckily, we don't have to worry ourselves about this because a lot of contracts don't have this anymore. Not a lot of Malaysian contracts have production-based split. Very few remaining. Okay, and you contrast this against what is ROVC. Okay, so let's go to what is ROVC. Okay, ROVC PSC is simply a revenue over cost. That's what R means and what C means. R is revenue, C is cost. Okay, ROVC PSC is an example of a profitability-based fiscal term. Okay, it is common to Malaysian PSCs issued post 97. Okay, it has this index called ROVC. R is simply the cumulative contractor revenue. If we recall from a few slides back, what is the contractor's revenue? Contractor's revenue is the cost recovery plus its share of profits, right? So see this at the bottom? Okay. Over the cumulative cost. What does it mean? What does this index mean? Okay, let's think about what ROVC equals 1 mean, right? If ROVC equals 1, it means that the contractor has recovered enough from has received enough from its share of cost recovery and profit to cover all the costs it has spent to date. Okay, ROVC less than 1 means it's still in a phase where it's trying to recover all the costs it has spent, right? ROVC greater than 1 means, you know, my revenue is now in excess of the money that I have spent in the asset, right? So typically it forms, it's typically coined as profitability base. This is an unitless number. It's an index, right? It's a dollar divided by dollar, so it's unitless, okay? And this index, why is it important? The ROVC index determines the limits of cost recovery, i.e. the cost recovery ceiling, and how much the contractor take home. Okay, what do I mean by this? We'll go over to the next slide where I can talk about this a little bit more. But basically, if you take a look at this chart over here, this is an example of an ROVC for a particular asset, okay, or PSC. So in the beginning, when you're still exploring, no production, 0, 0, 0, nothing, no revenue, right? And then what happens is, boom, you have revenue. So suddenly you get this upslope here, right? Okay, so that means you're producing and you're starting to catch up to pay back all your costs, right? And then what happens here? What's this funny thing? Why this dip here, right? So what happens is, for example, if you have a redevelopment or a phase 2, right? How does this change your ROVC? What happens? Think of it, right? The cost portion, the denominator now gets bigger, right? Because of the additional capex, like, you know, for your reinvestment and redevelopment. So the ROVC will drop, right? The ROVC drops from, in this case, 1.9 or whatever it is to 1.4. So what does this mean? automatically the contractor now enjoys a larger portion of the profit versus before, right? So this is why it's self-adjusting, sliding scale, profitability-based PSC, okay? Now, I talk about cost recovery. I assume everybody knows what it is, but I think I'll still spend a little bit of time talking about what it is actually, all right? So cost recovery is essentially a mechanism by which, the contractor gets repaid for the cost that it has spent, right? Again, think about it from a conceptual basis, what I said just now. The resources belong to the host authorities or the governing bodies. And so therefore, for every cost that you spend, you get repaid back, right? To develop the field. Okay, so and this is allocated back through production typically, right? Which is why we call this entitlement. Okay, so we have this thing called this cost bank. Think of it as a bank, okay? You spend money, you keep on spending money. So you build this balance in the bank, okay? This cost bank, where until the point where you have revenue, then you start paying back, right? Then you start getting paid back, right? So once you start getting paid back, the amount that you get paid back is essentially called cost recovery. Whatever left remaining in this bank is unrecovered costs, okay? So it sounds weird to think of cost as a bank, but if you think of it that way, it might help in your understanding, okay? For example, let's give a stylized example here. So in the beginning of the decade, for example, you would just be spending money and collecting costs, right? So this yellow line or brown line is essentially cumulative costs. So you've built up your costs over time because you spent money, exploration, development, etc. Then 2016, in this example, you have revenue. Ta-da! Okay, so from this revenue, as you can see from previous discussion, not all of it can be used for cost recovery, okay? Usually a small percentage is left behind as profit or recognized as profit in the contract to allow this to be split between host authorities and contractor, okay? So for example, in this case, let's count this 7 bars, okay? This is 7 lines, so let's call it 70 million. So you've racked up 70 million of costs, okay? And you can only recover 40 million of it, okay? So that particular period of time, you get to recover 40 million of the 70, and the remaining 30 gets carried forward to the following period, okay? Then it gets recovered from the production of the following period, and so on and so forth, okay? So this is stylized over a longer period of time as such, where at the beginning your cost recovery might be capped to whatever the ceiling is, okay, the ceiling rate, and then once you start recovering all your costs, and you become cost current, there's no more unrecovered costs in the cost bank. Then your actual cost recovery is essentially what you spend. What you spend this year is what you get to recover this year. Okay. Ooh, okay, profit split. Um, okay, so we talk about this part here. You see this thing where this thing is called profit? How do you split this profit between the host authorities and contractor? Okay, so in an R/C PSC, the profit split is determined by the R/C index. Okay, so you, as mentioned before, if R/C is less than 1, for example, the contractor gets 80% of the profit. Okay, if R/C is more than 2, it gets only half the share of a profit. Okay, this is one such method to split the profit between host authorities and contractor. Another way is, it could, like I said just now, it could be based on the production share, production base, right? So based on how much you produce, that average number is what you split between the contractor and the host authorities. Okay, cool. Now, and another feature of Malaysian PSC is threshold volume. With regards to threshold volume, it is actually a feature that that's been put in to encourage new investments, or specifically new field investments, right? In the old days, talking about 85 PSC or deep water PSC, the threshold volume is set at contract level, so the entire contract area, okay? But in the ROVC PSC, each of this threshold volume is on a field by field basis. So if you develop one oil field, your threshold volume is 30 million barrels, or the EUR, whichever is smaller. Okay. If you have two fields, you get to your threshold volume is now 60 million barrels, or the EUR, whichever is smaller. Okay. So it can be applied on contractual level or PSC level. You have to look at it from a contract by contract basis. So, sorry, contract level or fee level, and you have to look at it based on the contract. Okay. Why is this important? Okay. So if you take a look at this, and this is what I was trying to get to. This slide is what I was trying to get to from the last 3 slides. Okay, based on the particular R over C, it determines, this is the Malaysian R over C, okay, table. So for oil, for example, if R over C was, say, 1, okay, the cost recovery ceiling is 60%. TCT is total cost tranche, so that's like your cost recovery ceiling, okay? And if you're producing below THV, the contractor gets to take home 60%. But if the field or the PSC is producing above THV, for example, the contractor only takes home 30%. Okay, there's a thing called unused cost, but we'll just skip over that concept at this point in time. Okay, so that's how you read this thing, and this is why the R over C is such an important index in the 97 PSC, because it determines how much cost you get to recover and how much profit you take home. Yeah, okay. One more thing that we cover, that is a term inside a typical term inside Malaysian PSEs, is a supplementary payment. Now, supplementary payment is a feature to manage excess profit when that's due to oil prices, right? So if you think about contracts signed in maybe late 90s or early 2000, oil prices then were like $20, $30, right? So you know, all the fiscal terms was set up according to, say, $20, $30, $40 oil scenario, right? And then what happened in 2010, right? That part, that towards the end of the decade, oil prices were $110, right? So it's not through the fact of the project, it's because the global oil market demand and supply had a shock, okay? So oil prices went up. Now, the question is, you know, how do we manage this? In some fiscal regimes, this is handled through WPT, windfall profit tax, right? Like in the North Sea and things like that, there are, I think Norway might have it, but there are measures in place, essentially, when oil price hits, you know, above a certain limit, additional tax comes in or kicks in, okay? In Malaysian PSC and other PSCs, I think Brunei has something similar as well, there's this concept of supplementary payment. So you design the contract based on a base price, okay? And then if oil prices hit above a particular price limit, what happens is that excess profit is essentially shared between the contractor and the host authority at a specified rate, okay? So obviously the base price is not just a flat price, it's an escalating price to allow for inflation, escalation, etc. What is important in supplementary payment calculation is you must have the base price, when is the reference year, how much you need to escalate the price by, and what is the supplementary payment rate, okay? So I don't want to talk too much about the THV and supplementary payment because the new fiscal system, the new fiscal terms in Malaysia tend not to have, well, the EPT that I'm going to cover doesn't have these two anymore. So only if you're working with the 97 R over C PSC will you find the supplementary payment and the threshold volume still in effect. Okay. There are other types of fiscal payments that we have. So we have, for example, abandonment fund. Abandonment fund is contribution by the contractor into the abandonment fund. However, this contribution is cost recoverable. So ultimately, you know, it's still, think about it, the assets, the platforms, wells belong to the host authorities, right? So ultimately, the one paying for it is the host authority by allowing this cost to be cost recoverable, okay? And then you have, for example, export duties, research cess, training commitment, education fund. So these are all part of, you know, payments that the PSC specifies. Usually it's de minimis, it's not a lot. It's like 0.1% of, you know, contractor's entitlement or something like that, okay? So it's contract by contract basis and depends on what is negotiated as well, I think. So I can't be, you know, can't generalize so much. Okay. So I promised I was going to cover these 3 new things that is, you know, that is new to the Malaysian fiscal system. One is the late life asset PSC. Now, in the late life asset PSC, we've completely gone away with the cost recovery concept. Okay, no such thing as cost recovery. What happens is it's similar to a gross split PSC, where the barrel is split just three ways. Okay, one for cash payment, i.e. royalty, and then a portion that Petronas takes as its share, and then the remainder is the contractor's share to do what you will. Okay, insofar as to pay for your costs, to pay for everything else. Okay, so for the development of the field, the operating costs, the capex, any investment that you have to make, you take it from your contractor share. So this does away with a lot of things like cost recovery. You don't need to calculate, right? Profit split is, you don't have to think about it. It's already predetermined upfront. And in most contracts, this is biddable, in fact, right? So you get to bid how much of the profit you want to share between the host authorities and yourself. Okay. So this is relatively new, and this is specifically for late life, right? And you can imagine why. So we're talking about the last remaining, teens of barrels, right? Tens of barrels. So, managing costs is very important at this point in time, right? So, and managing asset decommissioning is also important, okay? So that's why in late life asset PSCs, there's an agreement, there's an agreed number upfront between the contractor and the host authority, how much of the decommissioning is going to cost, okay? And when the contractor carries out the decommissioning activities itself, if they come in below the estimate, they get to keep a little bit of the portion that they save, okay, a portion of they save. And if they come in above, then they have to pay for whatever remainder that is not sufficient, right? So there's a bit more of this in detail in our website. So best to just take a look there and essentially write in and if you have any questions, okay? So that's the late life asset PSC. I hope I didn't watch that, okay? Similarly, the small field asset PSC is also of a similar construct, where it's essentially also typically like a gross split. So we take away 10% for royalties, cash payment, and then Petronas takes a share of profit. Okay, there's usually a minimum specified, like 5% or something like that, or 10. I'm not sure what it is. And then the remainder is for the contractor to take home. Okay, it's relatively simple because then contractor doesn't have to figure out how much am I going to actually take home today, right? The challenge with the previous PSCs is it depends on so many things: your revenue, your costs, your ROVC, all those kind of stuff, right? So this way, upfront, if I produce 10 barrels, I get to take home 7 barrels, and I can manage my cost from the 7 barrels. Okay, there's no more cost recovery in SFA either. Okay. And again, the percentage that goes to Petronas as profit is biddable. So to make it competitive, the bigger Petronas the share, the more likely you are to win the bid technically. Okay. Right. The last thing that I'm going to cover is the EPT, which is the Enhanced Profitability Term PSC. This was just launched in Malaysia bid round 2021. In fact, I presented this. So this still has cost recovery in it. Okay. So all new shallow water PSCs will have these terms inside it. Will have this term essentially. Okay. So now, the barrel, say for example, the 100%, again, 10% goes to cash payment royalty. Okay. And cost recovery is now fixed. No more moving ceilings or whatever. The ceiling is now 70%. Okay. So that means absolutely there will always be 7, 10, 20% that's shared between the contractor and the host authorities. Okay. And how is this shared? Now it's shared through an index called PI, profitability indicator. I don't know why we like indicators, but okay, it's called PI, profitability indicators. Okay, it's similar to the ROVC actually insofar as how you calculate the PI. It's your cumulative revenue over cumulative costs. Okay, recoverable costs. But the difference is, and this is a huge difference, okay, is that, it's, if you look at it here, sorry, I can't find my cursor. Okay, it's like 90% or relatively high in the beginning, right? And it's essentially a extrapolated function. Once you get down to PI of 2.5, okay, it's 30%. So this makes it very responsive to change, right? Because you're extrapolating between points instead of tiering, right? So previously, if you're between, there's no difference if you're between 1.01 to 1.40 because you're still in the same tranche, right? When you do away with the tranching, what it makes this fiscal system more responsive to changes between cost and revenue, okay? So exciting things about the APT, now we only have a single cost bank. It's something I didn't cover before in the cost recovery, but in the cost banks typically are ring fence between oil revenues and gas revenues, right? Which is why it's important to allocate cost properly or determine cost properly between your oil cost bank and gas cost bank, okay? So for EPT, that's now no longer something that you need to concern yourself about. It's only one single cost bank. Like I said, it's a fixed recovery ceiling of 70%. The sharing is linear, it's given by a function that you can just calculate. It's not based on tranching anymore. And an exciting thing is, we've done away with the threshold volume and the supplementary payment. As you can tell, supplementary payment sometimes is quite a lot, right? Especially if, for example, oil price hits 100, right? So quite a lot of payment goes to supplementary payment. Now we've done away with that. Essentially, any profit is shared according to these terms, right? Between the split that we can calculate. Okay. So I've spoken for a long time. Let's just go over one example cash flow before I wrap up. Okay. So all these fiscal terms, all should translate into my cash flow. What does it mean, right? Okay. So if we think back to where I started 40 minutes ago, cash flow is just cash in minus cash out. Okay. So you've got this portion here, which is, all the parts. So you've got your gross revenue, your cash payment, your cost recovery, your profit that you have to split between government and contractor. Okay. I've used the EPT fiscal term here. So you can just sense check, right? You can always check my numbers. Okay, so cash payment should be 10% of revenue. Ta-da, 172 over 1718, 10%. Okay. Cost recovery is capped at 70%. Okay. So something critical that you have to understand, you only recover up to 70% of your revenue or whatever cost you actually spend, right? So for example, in year 2025 here, right, you are cost max. Your cost bank is full of unrecovered costs. So you get to recover the full 70% of it. Okay. Subsequent years, that's not the case, right? So for example, look at year 2032. I have 126 million of revenue. Technically, my cost ceiling is most probably like 80, 90 million, right? But I only recover 11 million, okay? Because that's the actual cost that I spend, okay? So that's this cost recovery portion here. And then the profit is split according to that PI ruler. I can show it to you, but we might run out of time. So basically, just trust me. I've calculated this such that, if the PI is less than 1, the contractor takes 90% of it. So you can just take a look here, right? The total profit is, say, 10, and the contractor takes 9, and the government takes 1, right? So that's 90%, right? So towards the tail end, that's not the case anymore. I think this is closer to a 45 or 50% split, right? Okay, so let's think about a contractor's cash flow. What is income to the contractor? Again, I repeat, it is the cost recovery plus its share of profit, right? So you can see the sum, 1243 is 554 plus 689, okay? So that's what the contractor sees. If I open my buku 55 or my book, okay, income is 1243. Now what goes out the door? I'll be having to pay for OPEX, okay, the tax that I have to pay to get your income after tax, and then also the CapEx, right, to get essentially the investment to get such production. So that gives you then contractor after tax net cash flow, okay? This is where the economist job kind of like starts in terms of analysis. Okay, all the number crunching stops here, and then from the net cash flow is when we start looking at profitability indicators. We talk about NPV, IRR. Now those concepts takes a while. Those things take a while to cover in terms of concept. So just look it up if you want to. But it's all starts from the net cash flow. Okay. Now, so like I mentioned, contractors revenue is cost recovery plus profit. Let's take a couple of minutes to just digest and reflect and actually try and practically extract something from this cash flow that I've given. Okay. So what is the contractor's net take in this example? Do you recall what the contractor's net take is? I'm not sure, but okay. Think about this as the barrel. Okay, you can this is what the barrel split looks like in reality, essentially, right? Your total revenue is really small, but you have to see it on the right side. Okay, your total revenue is 1.7 billion. Okay, your cash payment is 172. The total cost is 554. The contractor's profit is such. So what is the contractor's net take? I hope you take your calculator out with you and you can work this out yourself. Okay, you need most probably these numbers or the numbers here to calculate what the net take is. Okay, so the contractor's net take is, in this case, the profit that it takes home over revenue minus costs. Okay, so you take this 427 divide by 1718 minus these two numbers 554. Okay, and you'll end up with 37% roughly. So basically then the contractor's net take for this particular project is 37%. Okay, cool.
Right. Hi, Amy. I just want to let you guys know that we have hit the 1:15 p.m.
Okay.
mark.
Yeah, I'm just at the last slide, so just nice actually. So we've got then in summary, the fiscal terms only is really applicable when there's divisible income. Okay, it's supposed to address the risk and reward between the the host authorities and the contractors and finding an equitable level for this. Okay. As you can tell, the Malaysian fiscal petroleum arrangement has been evolving over time to accommodate all the changes, right? We used to find fields in the hundreds of millions of barrels, and then it became tens of millions of barrels, right? So, and then now we're concerned about assets nearing end of field life. So, evolution is necessary essentially to ensure that rewards are given or are shared equitably, and also to address the factor of risk, right, and the level of risk in each particular investment. There are other things that the government has done, and that's not part of what I've covered, and that's essentially the tax that with the LHDN, or the government of Malaysia rather, has offered a lot of tax incentives to remain competitive in the upstream business. So this would be things like investment tax allowance, marginal fees, and things like that. So there's a lot more information if you look it up online. But basically, I hope this, in essence, kind of like give you an idea of what petroleum economics is all about, and how the Malaysian fiscal system works. And if you have any questions, please do write in to the chat box, and then hopefully Isha will ask me questions. Okay, I think that's it for me.
All right. Thank you, Amy, for the sharing just now. So, just to let everyone know, a heads up that we'll be having photo session after the Q&A. So I hope this gives more time for you to get ready for the camera. So now let's proceed to the Q&A session. As this is a very interesting topic, we have received a lot of questions in the chat box. Okay, let me try to go. Right. From Nakiuddin Nordin, I wonder where will be the double tax deduction for R&D costs. Is this through internal R&D, such as PRSP or UTP, or external R&D? And what are the other incentive or mechanisms to promote more R&D growth?
Oh, that's a question that I'm not able to answer with clarity, I think. We're talking about deductions for R&D. I think that's very much specific to industries, and I think we might have to consult what the current existing rules are. So I might have to pass on that question because I'm not able to answer that part.
All right.
Oh, yeah.
Next, from Hisham, OPEX, would that include the onshore terminals and processing plants such as GPP, refineries, etc.?
That is a great question. The answer is always it depends. Okay, if you ask an economist, the answer is it depends. It depends on what is considered upstream asset. If the upstream asset, or if you draw a boundary, if the delivery point is past is inclusive of all that costs, right? Then it's considered upstream OPEX, right? It doesn't matter whether physically it's onshore or offshore, but basically if it hits the delivery point of the PSC or of the sales of the agreement, then that point is essentially still considered upstream. Up of the upstream of that point is still upstream. Downstream of that point is then downstream. So it could cover things like GPP costs and things like that. But again, it's specific case by case, and you need to look at it in terms of the contracts and agreements in place. Okay, because we have instances where it's both. So yeah, very messy.
Right. How does the fluctuation of commodity prices such as oil, gas, or petchem affect the initial economic model? Will the model be continuously validated over time, and how frequent would that be?
That's a great question as well. So commodity price change on a daily basis, right? And the model itself doesn't impinge on a particular price. Price is an input into the model, right? So you can change the price daily if you wish, but typically the model is updated, the prices are updated only like a few times a year, when the corporate price deck changes or when there's significant change in the market prices, right? Also, actually, this is part of the sensitivity scenario that we run. What if oil price were higher or lower, or where we are? So that's why we typically don't run projects at just a single price. We run it using multiple price forecasts. You could use external price forecasts, you could use internal in-house price forecasts and things like that. So.
All right, thank you.
Okay. Going back to the research question, the R&D part, there is an allocation or a payment of 0.5% of entitlement for research cess. However, the deductibility of that for tax payments and incentives, I'm not able to actually necessarily comment in detail.
All right. Okay, next question might be sensational. Who is the host authority in Sarawak? This is from Amir Hisham.
What does that mean exactly? What does host authority? Host authority, okay. So I don't know whether this is something I can answer or cannot answer actually, but essentially resources have been resources are owned by the government, essentially government/people of Malaysia, right? And this is assigned through to Petronas through the PDA, the Petroleum Development Act in 1974. So the PDA then authorizes or gives a mandate to Petronas to manage the resources. By host authority is like, I don't know what that means, because host authority, from our perspective, are multiple parties, right? You've got IRB that collects taxes. You've got customs that takes in the excise duties or import duties, right? So, I'm not clear what the question is, but I think I understand what it is alluding to. But I think, that's so someone's answering that the host authority onshore is Petros. That's for onshore, I think. For offshore development, I think it's slightly different. But yes, not able to answer that question in detail. Sorry.
All right, another question from Naki. What are the mechanisms or incentives to spur the development of high sulfur, high CO2, marginal, deep or ultra deep fields? What are the terms for fields in the Malaysia? Oh, this is another question. So yeah, the first one. What are the mechanisms or incentives to spur the development of high sulfur, high CO2, marginal, deep, ultra deep fields?
So we have specific fiscal terms for HPHT, high pressure, high temperature fields. On top of that, what is also relevant is what the tax authorities offer as incentives. Okay, so we have, for example, investment tax allowance for high CO2, high contaminant fields that allows you to recover 60% above what you actually spend, right? And what else? What other types of fuel was it? Marginal fuels. So marginal fuels, for example, has accelerated depreciation, for example. So it's something that we do offer, but that's through reduction of taxes, essentially, not just through fiscal mechanism.
Okay.
That's that question. Yeah. I'll paste a picture on the incentives that's available in a minute. Yeah.
Okay. How does long-term master service agreement (MSA) for integrated turnaround main mechanical and maintenance mechanical static assist the cost optimization and contractors' competency? Will this affect the local Bumiputra SMEs?
Oh, I don't know how to answer this question. How does the what? Sorry, say that again.
How does the long-term master service agreement
Okay.
(MSA) for integrated turnaround main mechanical and maintenance mechanical static (TA for MS) assist in the cost optimization and contractors' competency?
Oh, okay. I think, if I'm not mistaken, and I might be wrong here, because I don't necessarily handle a lot of this costing type issues. The that agreement, the master agreement, is supposed to help, find the most competitive price, I think, if I'm not mistaken, in the market, right? So overall, that should already reflect and help you with, optimizing your cost and finding out what's best in the market. But I actually have, very little knowledge on this, and so is it okay if I give a pass on this question as well? Because,
Sure, we can
I could work with.
definitely compile all the questions and then
Yes.
maybe later we can give it to you and then you can draft your answer later on and we
And I'll
send
give
to
it to
the
the relevant parties to answer this question. That's much better.
yeah.
Economics is so huge. I just want to answer cash flow questions,
Okay, apart from the EPT that being introduced, any other measures that Petronas is taking to attract the overseas investors to continue investing in Malaysia, whereby the recent Repsol assets are being sold to Hibiscus? Is that something
Yeah.
that you can answer?
So, yeah, I can try and answer that. Okay, so the challenge is, it's the oil and gas industry here is maturing, so you cannot get over, you have to understand that as well, right? So, sometimes companies leave not because it could be because of, for whatever reason that's known to the company, presumably. The challenge is, can we continuously make it attractive, based on, what everybody's appetite is, right? So in this particular case, I know Repsol is selling out to Hibiscus, right, basically. But imagine this, okay? So if I have a company, that's cost structure can be lower, right? So they find something more economic or something more interesting. Two companies will see different things in the same field. Okay, you can see this even when you have partners in your PSC, right? So I see things. I see this field as being 10 million barrels. The other company sees it as 15 million barrels. So it might not work for me, but it might work for someone else, right? So individual decisions on why people move in and out, that's just part of usually portfolio optimization and what is attractive. What can we do as host authorities to actually encourage investment is to actually, like I said, stay relevant. We understand, the issues, the burning issues with that the contractors are facing, because we are contractors ourselves in some PSCs, right? Cherry Gali is a contractor in some PSCs. So, things like addressing late life, smaller fields, higher contaminant fields, these are all things we're trying to stay on top of. And I think so long as you stay relevant, and you understand how competitive you are in the market, investors will come. We just have to make sure that it's, the prospectivity is there along with the fiscal mechanism. If you recall, fiscal is just one part, right? The other part is actually having the resources, the prospectivity out there must be, something that's exciting that people want to find out. So we unlock plays as time goes on. Technology unlocks different kinds of plays, right? So that's why it's kind of like, hopefully we're doing enough things to stay relevant and stay competitive across the global market for investors.
All right. All right. I think thank you for all the questions posted in the chat box. Unfortunately, we're pressed on time and we will compile all your questions and we'll give a feedback or response to the questions given in the chat box. Yes. Okay. Now let's move on for a quick photo session. I hope everyone could turn on the camera. Before we move on to Kahoot, let's take a quick photo together. Yes, let's fill up the seats.
Are we doing this in together mode?
Yeah, I have opened it in together mode. Who's taking picture is Faiz or Pijal?
All right, sure. I can help to be the photographer here. Let's do.
Thanks,
Let's do.
Faiz.
It's okay. One is the large gallery, and one is another one. What do you call it? Together mode. Smile. One, two, and three. One more. One, two, and three. One more. Last one. Let me go to the together mode now. Let's join us. Anyone else want to join before we go to Kahoot session? Okay, this is good. Satu, dua, tiga. All right, excellent. Thank you for your smile. Back to you.
Thank you, Faiz. Okay, let me share my screen for Kahoot.
Just a reminder to have a calculator with you.
Yes.
One question will be a calculation question, just one.
We should prepare calculator or Excel.
It's okay. If your mental arithmetic is good, it should be done this year.
I mean, okay.
Okay, please let me know if you can see the screen. Can you hear the sound?
Yes, we can hear.
Yes, softly we hear. We can increase a bit maybe. Yep. That's good.
We have 20 people joining. I believe there are more people in the meeting. Maybe we can make it 30. We have King Dog. Would that be all? Is there anyone else who'd like to join? In 10 seconds, I will start the game. We have a decreased participants. Oh. Okay, with this, 5. Is there anyone else? 4, 3, 2, 1. Okay, we'll start. A walkthrough of Malaysian PSCs. Which of these is not a type of petroleum contract which determines split of hydrocarbon revenue between parties? A. Production sharing contract, service contract, FPCSO, lease contract, or concession agreement. It's FPSO lease contract. Let's see who's on lead. It's Lapar with 928. AGI and PSC. Right, let's move on to the next question. In R over C, revenue refers to cumulative. Gross revenue, revenue after royalty, or is it cost recovery or cost recovery and contractors profit share? It's cost recovery and contractors profit share. Many also answered gross revenue. Let's see who's leading. It's Lapar again, followed by 1, 2, 3, and then Chan. Okay. What is the typical cash payment rate for Malaysian PSCs? Starting to see numbers here. Is it 5%, 10%, 12.5%, or 8.25%? And then it's 10%. Lapar is still leading with 1, 2, 3 SK, and then we have a new entry from Shah here. Which of these are types of PSC payments? Select all that applies. This is a multi-selection question. Which of these are types of PSC payments? More than one answer. Could be 2 answer, 3 answer. Oh yes. Not bad. I mean, like, we have 13 people from the audience that answered it correctly. Let's go to the next one. We still have Lapar leading. He must be very hungry to get through this quiz. So which of these are not a feature of R over C PSC? Is it cost recovery, threshold volume, tax incentive, or supplementary payment? Answer is tax incentive. I see that many of us answered supplementary payment. Well, Lapa is still leading with LST and SK. True or false? Net cash flow is cash inflow minus cash outflow. Is it true or false? Yep. Many of you guys answered true, which is correct. Lapar is still leading. This is the calculation question. Please take out your calculator. Calculate the net contractor take based on the following data. So we have the gross revenue, cost, contractor profit, tax, and government profit. We have allocated specifically 30 seconds for this question. Hope that will be enough for you to answer, to calculate the answer. 2, 1. Oh, nice. A lot of you guys have managed to calculate it correctly. Let's see. Okay, SK has overtaken Lapar and take the first place. Which of these is not cash inflow or outflow? Is it capital allowance, cost recovery, taxes, cash payment, or royalty? It's capital allowance. Yes, many of you got it correct. SK is still leading with 7,591. Lapar is not that far behind. Okay, next question. This is like the second last. When was the enhanced profitability term PSC launch? If you remember the chart just now, and it was also described quite in detail. Yep, it was launched in 2021. SK is still leading. Let's go to the last question. What is the contractor's profit share if the R over C is 1.25 and the production volume has exceeded the threshold volume? You can refer to the table here. If the RSC is 1.2 and it exceeds the threshold volume. Congrats. The answer is 30%. Let's see who is the final winner. Yep. Third place is 123, second place is Lapar, and the first place, congratulations to SK with points 9,311. Thank you so much for participating. I hope SK could stay behind to provide your details for the prize, to claim the prize. All right. Let me try to get it, share the screen again. All right, so that was Kahoot. Thank you so much for joining. Before we end our session, a few gentle reminders. Don't forget to provide your feedback on the event today. We have given the link in the chat box. So next, we have our 9th installment on 1st September next week. The topic will be asset enrichment through reservoir surveillance operation well performance analysis by Ahmad Adib bin Abdullah. So definitely an interesting topic to be discussed. Follow closely our social media for updates and join us again on the same time, same place next week. Take care, everyone. Thank you, Miss Amy, for
Thank you. Thanks everyone
your
for
time.
attending.
Thank you, Amy.
That's okay. That's okay. I hope
Thank
that
you,
was
Miss Amy.
helpful. Thank
It
you.
was.
I'll catch up with you guys later, okay?
Yes.
Okay, thank you, Isha.
Thank you.
Good luck with the next meeting.
Yes, I have to run. Bye.
All right. Thank you. Bye. And may I ask SK, who just won the Kahoot quiz just now, to just stay on the line, identify yourself, and or maybe type your phone number if you don't mind.